Hi, and welcome back to the Business Career College video series. In this video, we're going to look at old age security. And we're going to see that old age security is a fairly straightforward benefit. There's not a lot of complexity to it. We do have to understand how it works and see when it would pay benefits. So the first thing we can look at here is that OAS is a non-contributory program. And what that means is that there's not a separate pool of dollars to fund OAS, and you'll never have a payroll deduction related to OAS premiums or any of those types of issues. And then we see that OAS is based on residency. So in order to collect any OAS benefit, you have to have a minimum of 10 years of residency and be at least age 65. So we're looking for minimum 10 years of residency, starting at age 18. So residency as a child doesn't really count here. We're looking only to start counting residency at age 18. And it doesn't matter about citizenship. This has nothing to do with your citizenship status. This is purely about where you live. Now, you do have to be at least age 65 in order to collect this. Now, some of you are probably aware that there are some changes coming to this, but these changes won't take effect until 2023. So for now, we're still using a minimum age 65. And if you do meet these criteria, then you become eligible for an OAS benefit. And your OAS benefit is paid on a monthly basis. So we have a monthly benefit. As we're quite used to by now, this is a taxable benefit and it's indexed. OAS is a little bit funny because it's indexed quarterly to inflation. So over the course of the year, it would get a full year's adjustment for inflation, but it actually changes every single quarter. So as of the last quarter of 2013, the OAS benefit right now is $550.99 per month maximum. Now that would assume that you have 40 years of residency. There is a slightly different set of rules for somebody who was at least age 25 and a Canadian resident prior to 1977. It's not something you have to concern yourself with for the most part. If you're doing maybe a financial planning exam, that could show up, but it's a pretty fine level of detail to test in order to get to that. So with 40 years of residency, you would have the maximum, and then anything less than that, you would have something less. So let's say we have, just to keep it easy here, let's say we have somebody with 25 years of residency out of a possible 40. So they would qualify for 25/40ths, or 62.5% of that $550.99. This person would qualify for a benefit of $344.37. And that would still be taxable and it would still be indexed to inflation, but it's not going to grow to meet these extra years of eligibility either. So this person is going to obviously continue living in Canada after they start collecting this, but they're not going to have their benefit increase by the missing 2.5% per year. They're just going to be stuck at that $344.37, although it'll be indexed. Now, you do have to have a minimum 10 years of residency if you want to collect this. I apologize, sorry, 20 years. You have to have a minimum of 20 years of residency if you want to collect this while you're a non-resident. There are some exceptions to that. We have some treaties with other countries where there's sort of a reciprocal agreement around OAS where we might have credit for time in another country and they might give credit for our residency here. Really, this is something that you look at on a very case-by-case basis. Now, OAS is subject to some changes that we are dealing with right now. So the first thing is, similar to what we can have with Canada Pension Plan, you can actually wait. So you can actually wait up to an extra 5 years after you become eligible. And if you do wait up to an extra 5 years, you're going to have an increase, again, very similar to what we see with Canada Pension Plan, of 0.6% per month. So not identical to CPP, but very similar, that you wait. So if we have somebody who waits all the way to age 70, they'll have no benefit between 65 and 70, but then they'll have, that's 5 years times 12 months times 0.6%, that would be a 36% increase to the scheduled OAS benefit. So they would have their benefit increased by a pretty generous 36%. Okay, so then a well-known feature of old age security is the clawback. And we'll come back to some of the changes in a second as well. The other set of changes we have to look at doesn't start taking effect until 2023. We're going to look at the clawback first. So the old age security clawback is going to apply only to somebody who has very high income in retirement. So here's my case study. We have somebody who has income of, let's say, $90,000. And that's net income, so that's our line 236 income, which would be all of your income less your deductions from income. Okay, and that's going to be then at $90,000, about $70,000 is the threshold. So we have about a $70,000 threshold. That threshold does change every single year, but that's about where it's at right now. And you would be given that on an exam. You're not going to be expected to memorize what the threshold is, and it's especially difficult because it does change every single quarter when the OAS benefit changes. So let's say that this is the income at age 66. So at age 66, this person is a full $20,000 over the threshold. So now what happens is we take that $20,000 and we apply 15%. That's the figure you do have to know for an exam. That's something that I would suggest you should be carrying around in your head as you're preparing for any financial services exam. So now this person we can see is $3,000 over, or $250 over per month. So if they would have qualified for the $344.37 that we see over here, we would just take that $344.37, we would carve out that $250, and we would have $94.37. That would be the remaining OAS benefit. Now, we did this calculation at age 66, so this would adjust the benefit at age 67. So this would be their age 67 benefit. And then at age 67, we would do the calculation again for 68 and so forth. And there is a little bit of a funny here where if you have a year where you have an exceptional amount of income, your income is quite high just because of maybe selling a business or some activity like that, you can actually apply on a one-off basis to have your OAS clawback applied to the current year's income. But if it's going to be a recurring thing, so if income for this person is going to generally be around $90,000 a year, they would just have the clawback calculation done each year, and it would adjust their income in the their OAS benefit in the following year. The last thing to look at is the other set of changes with OAS, the other set of fairly substantial changes that's coming. Now this is starting in 2023. We're going to move eligibility back to age 67. So eventually we're going to have to wait until 67 to collect any OAS benefit. So this change will not affect anybody born in 1957 or earlier. For this person born in 1957 or earlier, it's always going to be age 65. And for the person born in 1963 or later, it will be age 67. This person will be fully affected by these changes. It's only the people in between here, people born in the years 58 to 62, where we have this phased change. And it's very circumstantial here. It's if you're born in 58, then it's a little different for somebody born in 59 and 60 and 61 and 62 and so forth. But it's fairly easy to see here the important dates, and then just in between you'd have this little bit of extra calculation to do. Now, one other thing that I always like to mention around OAS, there's a lot of financial planning considerations around OAS, but something that's a fairly easy bit of financial planning here is we said the minimum age for OAS is 65 and minimum 10 years of eligibility. So what if I have somebody who comes to Canada for the first time at the age of 57? So this person comes to Canada at age 57, and they've never had any residency here before. So now they start counting their residency at age 57. So when they get to 65, they have an issue here where they don't yet have 10 years of residency. So they're not OAS eligible. But what they can do is they can wait an additional 2 years, wait until age 67. At age 67 now, they will have their 10 years of eligibility, and then they can apply for OAS. They won't get a huge benefit. They would have only, if we just look down to the bottom left here, they would have only 10 years of eligibility. That'd be 1/4 of that benefit, but still, that's an OAS benefit that they otherwise wouldn't have access to. Now, that person would have to wait an ongoing period after age 67 in order to get this bump. They have to wait this extra 5 years starting when they become eligible for old age security. With old age security, there's no disability benefits, there's no death benefits, there's no built-in splitting, although one thing you'll often hear about with OAS is that we want to split income between spouses in order to maximize eligibility for the OAS benefit, that is to get away from the clawback. So there's a lot of planning done around the clawback. Whether that's an effective place to plan or not is a secondary issue. We can look at that when we get into some more detailed financial planning discussions. So I hope that helps. OAS is often considered the first pillar of retirement income. It's a very easy program to have access to if you've lived in Canada for a relatively long time as an adult. You're going to get a decent OAS benefit, although it's not going to be enough. We said $550 a month or thereabouts. It's not going to be enough to have a comfortable retirement on it any stretch by itself. It is a common enough benefit that you do have to have good awareness of it. Virtually everybody is going to be concerned about OAS at some point in their lifetime. I hope that helps. Enjoy your ongoing studies. Thank you. Hi, and welcome back to the Business Career College video series. It's Jason Watt, and in this video what we're going to look at is the Guaranteed Income Supplement, which is part of the OAS program. We've covered OAS in a previous video. So the GIS is specifically designed for somebody who is collecting OAS, and you have to look at the OAS video in order to determine that eligibility. So we're looking for an OAS recipient. And obviously then they have to be age 65 plus, at least as of today. We know that's going to change to 67, but not for quite a while yet. And specifically we're looking for somebody who has low income. Now, one of the things that's worth mentioning here as far as eligibility, you may recall in the GIS video I had mentioned that 65 is simply the minimum age at which to collect OAS, but you don't have to be only 65. If we have somebody who comes to Canada at, say, age 57, they might wait until 67 then, or they would have to wait until 67 in order to be eligible to collect any OAS. They wouldn't get a lot of OAS, but they could actually be eligible for the full amount of GIS. So sometimes when we're looking at the benefit programs, we simply are looking at OAS as a trigger for GIS. We may not be so concerned about the actual amount of OAS that would be paid. So what do we mean when we say low income? This is really our important discussion here. So what we're looking at here, and I'll show you some exceptions to this, but for the most part, we're looking at your line 236 income. That's net income. And we're looking for that line 236 income to not be over certain thresholds. For a single person, this would be paid only if income is somewhere less than about $17,000. These figures change every quarter, as we're now used to with the guaranteed income supplement benefits, but around $17,000 maximum. And for a couple, married or common law, doesn't matter, we're looking at maximum combined income for this couple of around $40,000. And once we're over those amounts, then there would be no more GIS. So you don't want to be collecting this. You have to have fairly low income in order to get this benefit at all. So how's it actually calculated? Well, for a single person, the maximum GIS benefit by itself is right around $700 a month. And for a couple, it's a maximum of around $500 a month. And again, these amounts change every quarter, but this is approximately where we sit today. And for a couple, it would be maximum $500 per month per person. Now, there is another little bit that can be paid here. And for a single person, there is an additional $50 supplement that's available. Or sorry, a $50 enhancement. Let's get that language right. And for a married person, there's an additional $35 a month enhancement per person. So each of them would be eligible for an extra $35 if income is below a certain threshold. Now, to get that $50 enhancement, this is only payable if your annual income is less than about $5,000. And for a couple, this is payable if your annual income is less than about $8,000. And those amounts change again every quarter. And to see the exact amounts, you'd have to look at the OAS calculator, which is available on the Service Canada website. But this is fundamentally how this works. So what we're most concerned with and what's most likely to be tested around GIS is how do you get this $7,000 and how do you get this $500 a month. So let's say, just to work through an example, that we have a single person. And my single person has annual income. We'll go annual here because there's a couple factors to consider when we look at annual income. So this person is taking money from a RIF. This person is earning income from OAS. This person has a little bit of Canada Pension Plan income and a little bit of employment income. So these are the things you're most likely to see tested as well. And let's say from the RIF we have $4,000 coming out each year. From OAS, which we know we have to have some of, let's say we're getting $5,000, near the maximum for OAS, maybe a little less because of less residency. And Canada Pension Plan, let's say we're getting about $6,000 here. And employment income, we just got a little part-time job here paying $5,000 a year. So when we look at the clawback calculation, the GIS clawback calculation, we have to look at what income to bring into this discussion. The RIF income we are going to bring into this discussion. The OAS we are not. That wouldn't make any sense because we have to have that income. The CPP we are bringing that income in. And the employment income is actually a little bit funny. We're allowed to have up to $3,500 of employment income, so we're only going to bring $1,500 over into this GIS clawback calculation. That first $3,500 a year is exempt from this calculation. So this person we see has $11,500 of income that would attract a clawback. So the first thing we see is that they are over their amount where they would get the enhancement. So this person will have no enhancement. So now we have a 50% clawback. Meaning that they are losing basically 50 cents for every dollar of income in that range. So they're going to have $11,500 times 2 is $5,750 of clawback applied to their OAS, or sorry, to their GIS, or we can figure out that amount per month, which brings us to right around $480, just a shot under $480 a month that would be clawed back. Now, if this were a couple, what we would do is we would take their total income as a couple, and then we would have a 25% clawback for that couple, but we would apply it to both of their amounts then. So with a $480 clawback, we see that this person would have been eligible for $700. We can see that here, but they have $480 of clawback, meaning that they will actually have $220 of GIS each month. Now this amount, this GIS benefit, it's indexed, and it's indexed to inflation each quarter, and actually it's paid tax-free. Both the GIS and the GIS enhancement would be paid tax-free. So, not a particularly generous benefit here, but it is just designed to provide that little bit of supplement for somebody who is age 65 plus and has low income. Just like with the OAS clawback, we would do this calculation each year. So we would do this calculation in, say, 2014, and that would impact the 2015 GIS amount, and then so on. You do the same calculation in 2015, and that would affect the 2016 GIS amount. It's a fairly straightforward benefit. The only real complexity to it is just knowing the amounts that are going to affect your benefit, and it really is just that OAS amount that doesn't get included and that first $3,500 of employment income. Everything else would get included. If you did have dividend income, the thing to note here, just like with your GIS clawback, is that dividend income you would have to use the grossed up amount. And of course we've seen the discussion around dividend gross up in our calculations around investment income and how it's taxed. I hope that helps. Enjoy your ongoing studies. Hi, and welcome back to the Business Career College video series. In this video, we're going to look at the allowance. And technically, there is a second program that's also part of the allowance, and that's the allowance for survivors. These are relatively little used benefits. There are only about 80,000 people in Canada using the allowance today. Sorry, let me make that clearer. That's a paragraph, or sorry, a parenthesis there. So what the allowance is, it's designed for the spouse of a GIS recipient. And we know that a GIS recipient has to be age 65 plus and has to have low income. And what we're looking for here is a spouse who is age 60 to 64 that is not yet old enough to get GIS, so there would be no GIS here, and has low income. And we already know that's the case because we know that to do the GIS calculation, we have to look at the spousal income anyways. So we're looking at the spouse of the GIS recipient who's age 60 to 64 and has low income. Of course, once this person gets to 65, that's when any allowance would end, and that's when OAS and presumably GIS would start. So the sort of classic example of where this would be applicable would be grandma and grandpa out on the farm, let's say that Grandpa's 65 and Grandma's 62. Grandpa's old enough now to start getting his GIS, and let's say he's got low CPP and low other income, no real retirement savings. And Grandma's not working anywhere off the farm. She's never had a regular paycheck and therefore never contributed to Canada Pension Plan. And now Grandpa starts getting his GIS, his OAS, a little bit of CPP. Grandma has no income, not much for Grandpa here, so Grandma would then be eligible until she gets to age 65 for the allowance. Now, the allowance is a little bit complicated. It's really sort of an ability to fast forward to get yourself some early eligibility for GIS and OAS, and the amount of benefit is about the same as the combined total of GIS and OAS for a married person, which is about $1,050 a month maximum. This amount is tax-free, and it is indexed quarterly to inflation. Now, it's subject to a clawback, and it's clawed back very quickly. So you won't have any allowance at all if you have income over about $31,000. So your income here has to be less than about $31,000. And if it's in that range, then you're going to have some allowance. It's a very complex clawback for this calculation. It's a 133% clawback on the first chunk of income, and then after that, it's a 50% clawback. So it's more complex than you'll see on an exam. You just have to know that it is clawed back and that it stops at about this level of income. But to do the actual allowance clawback calculation is outside the scope of what you'll normally have to do. Now, there is a second circumstance in which an allowance can be paid, and this is if you're the spouse of a deceased person and you would have qualified if that person were still alive. So that's where we get the survivor's benefit. If you have a deceased spouse, but you would have qualified had that person still been alive. And it's almost identical to the allowance. The only real difference here is just in the dollar amounts in the income threshold. So here you're looking at a maximum of about $1,200 a month. And here you can get income only up to about $22,000. It's actually about $22,500 of annual income, and then you would lose any allowance for survivors. Again, that amount is tax-free and it's indexed. It's not something that you're going to see a lot. I would suggest where you see this on an exam, it's more often going to be a wrong answer to a multiple choice question. But you do have this small number of people, like I said, about 80,000 people today in Canada collecting this benefit. I hope that helps. It's a fairly straightforward benefit, just a little bit of a potential red herring for some exam questions. Enjoy your ongoing studies, and thank you very much. Hi, and welcome back to the Business Career College video series. Again, this is Jason Watt, and in this video, we're going to talk about workers' compensation benefits. Now, this is a provincial plan, and it does vary from province to province. In fact, in most provinces, we're used to a workers' compensation board, but those of you in Ontario, of course, are used to the Workplace Safety Insurance Board, WSIB. And workers' compensation is a no-fault plan and a non-contributory plan. So the idea with workers' compensation is that if an employee gets hurt at work and can't earn an income as a result, they don't have to sue their employer for their lost wages. The employer has paid into workers' compensation, and now the employee has access to a ready pool of benefits in order to replace that lost income, and workers' compensation provides some other benefits as well. So a no-fault plan, non-contributory in nature. Employers pay premiums, but employees do not. So we'll never have an employee premium to workers' compensation. Now, Self-employed people sometimes have to pay into workers' comp, and that's a secondary issue. So what has to happen here? Well, you have to have an injury that is attributable to work. And it does vary a little bit from province to province what would be a valid claim and what would not. But generally, we're looking at something that happened while you're on the job, doing the job you're supposed to be doing in the hours that you're supposed to be doing it. You're not covered when you're doing work outside of your normal job, unless you have coverage for that other work. You're not covered when you are, say, commuting to and from work in most cases. So it has to be directly attributable to work. It could be an injury or it could be an illness, although illness claims for workers' compensation are relatively rare. So this benefit, this workers' compensation benefit, is going to provide a fairly generous income replacement. It's going to replace, in most cases, 90% of your after-tax income. Now there is a maximum here. It's a maximum of around $6,000 a month. It varies again from province to province, but somewhere in that vicinity. So it works well for somebody earning up to about $90,000 or $100,000, but after that, workers' compensation starts to lose its effectiveness. Not everybody is necessarily covered by workers' compensation. There are three classes of industry. There are exempt industries. Banking and insurance are two good examples of industries that are exempt from workers' comp. There are optional industries. A lot of not-for-profits fall into an optional category. And then mandatory. So most trades and blue-collar type of occupations have mandatory workers' compensation coverage. The benefit, when the benefit is paid, it's tax-free. And it's a one-day wait or next day coverage, one-day wait to collect workers' compensation benefits. It can pay benefits as long as age 65, but it generally doesn't. Workers' compensation will end up having lump sum payments where somebody looks to be disabled for a long time. They do have rehabilitation benefits and retraining benefits. In some cases, they will even retrain a spouse, for example, to have the spouse go back to work if the person who was injured at work is not ever able to return to work. Workers' compensation can pay death benefits for somebody who's killed on the job. Death benefits are normally equal to 2 years of lost income. So lots of different odds and ends with workers' compensation, and again, lots of provincial variation. One of the things you should be aware of, and probably most people who spend some time in the workforce are aware of this, is that it can be not necessarily hard to claim, but workers' comp is pretty aggressive in a lot of cases about getting people off of claims. So they're going to have, I would suggest, fairly aggressive rehab and return to work policies. That is, they're trying to maintain a program here that's essentially publicly funded or funded by all of these mandatory contributions from all these employers. They can't be in the business of paying out claims when it's not necessary. So they do tend to have fairly aggressive stances on getting people back to work. So that's workers' compensation. There's a lot more that you could learn about workers' compensation, but for most financial services exams, that should be sufficient. Levels of premiums vary from employer to employer, so even knowing premium rates and so forth is not practical. I hope that helps. I hope you enjoy your ongoing studies. Thank you very kindly. Hi, and welcome back to the Business Career College video series. Again, this is Jason Watt, and in this video, we're going to look at employment insurance. Now, there is a lot to know about employment insurance. We're going to try and just parse it down to the stuff that's most likely to be tested, the stuff you have to know really from a financial planning perspective. So employment insurance, first off, is a contributory program in which both the employer and employee contribute. Sorry, that's employee. So When the employee contributes at a rate of 1.88%, so they have to contribute 1.88% of their income, and the employer contributes 1.4 times that. So the employee's maximum contribution for 2014 is just a shot over $900. That's about $914. The employer's maximum contribution for 2014 is right around $1,280, just a shot under $1,280. That corresponds roughly to, or that corresponds exactly, I should say, to $48,600 of annual salary. So basically, once you're over $48,600, then contributions to EI stop. When the employer contributes to EI, that generates a tax deduction. That's a tax deductible expense for the employer. And when the employee contributes, that generates a tax credit. And as we've seen with other benefits, when you have that tax advantage at the front end, that means at the back end that all benefits are taxable. Now, in order to generate most types of EI income, we're looking at a minimum number of insured hours. And this varies quite a bit, actually, and it varies from region to region depending on the economic climate in that region. We're typically looking at between 500 to 700 insured hours, and there is some discrepancy there depending on the exact circumstance, but for the most part, to use an EI benefit, you have to meet that minimum number of insured hours requirement. And one other area that's a little bit complicated with EI potentially is EI for self-employed. So a self-employed person, and this includes a business owner or their family when that family collectively owns 40% or more of the business, then EI contributions are optional. And that means that that family would have to, or that owner would have to opt in to EI. And we're going to look at the benefits in a moment, but self-employed people cannot ever use the unemployment benefit. They can use sickness and parental and maternity leave benefits and compassionate care benefits, but they can never use the unemployment benefits. So presently the EI maximum, and it does change every quarter, I apologize. The EI maximum is just over $500. It's $517 a week to a maximum of 55% of your normal income. So EI will never replace more than 55% of your income, and they will never pay more than that $517 or whatever it is at the relevant time, $517 a week of your earned income. And of course, that $517 would be taxable. Now, EI is going to have a 2-week waiting period. And for the most part, we're looking at a 15-week benefit period, although there are a fair number of exceptions to that. And we'll see those right away. So what are the benefits that EI can pay out, or under what circumstances will EI pay a benefit? Well, there are quite a few. So we have unemployment or job loss, and at least on paper, this is a job loss through no fault of your own, so laid off, or your employer goes out of business, or you're terminated, whatever it happens to be. And this is the normal 2 weeks and 15 weeks, so 2 weeks wait and 15 weeks of benefits, pays a taxable benefit based on that $517 a week, very straightforward. We have sickness benefits as well. This is the one that's most likely to be tested on most financial services exams. Sickness benefits also have a 2-week waiting period, also provide 15 weeks of benefits. This does include accident benefits. And there's no requirement that this sickness or accident is attributable to work. It simply is that you have something wrong that prevents you from working. So in order to use sickness benefits, you have to have a doctor's note as well, indicating that you can't work, as well as an expected return to work. And we might have parental benefits and maternity benefits. Now, maternity benefits use the 2-week and 15 weeks that we're used to. Parental benefits, this is up to 35 weeks of benefits. This normally follows on the heels of a maternity benefit, which is a total of 50 weeks, which most people are accustomed to. And you can use parental benefits. You can split them between parents, or you can use them in the case of an adoption. You can't use maternity benefits in the case of an adoption. And the final benefit that we have to be aware of is the compassionate care benefit. And it provides up to 6 weeks of benefits. It's actually pretty tough to claim. You have to have a loved one where a doctor says that person is expected to die within the next year. Now, whatever benefit you do get, there is a withholding tax on any EI benefit. So you're not actually going to get as much as $517. You're going to get something less than that based on your tax rate at the time you start collecting benefits. And with unemployment benefits, only with unemployment benefits, there is a clawback possible if you earn too much income in the year. So if you have a high-paying job, you get laid off, and then you spend a period of time unemployed, and then return to the workforce, again in a high-paying job, you can have a clawback of those EI benefits. One other note about EI, and this is important if you're going through an insurance course, is that if you have some sort of group short-term disability plan or weekly indemnity plan, if it's better or equal to EI, that is 2 weeks of benefits and would replace at least 55% of income, if you have this group short-term disability in place, you qualify for the EI premium reduction program, which actually allows you to reduce the employer portion instead of then 1.4 times. It uses a different calculation. It's currently sitting at 1.27 times, but that amount can change. So this allows you to have a slightly reduced EI premium, and then what you have to do is you have to share that premium reduction with your employees. So there are some fairly complex mechanisms by which we give that back to our employees, because the employees don't get a break on their premiums, only the employer does. So to make this fair, we have to share that proportionally back with the employees. So as much as there's a lot more to potentially know about EI, for the sake of most financial services exams, this is really the stuff that you have to be aware of. You have to know that it's relatively easy to claim. It's not going to pay a huge amount of money. It pays in relatively short time, and it doesn't pay for a very long period of time. I hope that helps. That's employment insurance, and I hope you enjoy your ongoing studies. Thank you very kindly. Good day, and welcome back to the Business Career College video series. In this video, we're going to look at something that probably most people are familiar with, at least in its very broad sense. We're going to look at the Canada Health Act. Now, I'm going to first clear up a little bit of misunderstanding here. So the Canada Health Act is the mechanism that provides financing for the healthcare system that we use in this country. This is federal legislation. The federal government, for the most part, does not deliver health care. Instead, the actual delivery of health care is a provincial responsibility. So the provinces each have responsibility for delivering health care in their own jurisdictions. When they deliver that health care, though, as long as they fall within a set of principles, outlined within the Canada Health Act, then the federal government provides the majority or all of the funding required in order to pay for that delivery of health care. Now, the Canada Health Act as we know it today was introduced in 1984, came into legislation in 1985. Of course, it has a history dating back to the late 1930s, arguably the first meaningful legislation to bring about public delivery of healthcare in this country came about in Saskatchewan in 1947, and then we saw it take hold across the rest of the country, and we saw national healthcare or national payment of healthcare come about in the early 1960s. So the 5 principles with which we're concerned, and we're going to look at these as we develop this idea a little bit. We're going to look at universality. We're going to look at portability. We have to look at comprehensiveness. We'll see that it's publicly administered. And finally, that it's accessible. So what do each of these items mean? Well, we've seen each of these in practice, probably most of us at some point or another. So universality, this means that it has to apply to everybody. So we have to make sure it applies to everybody. Now, there is typically a residency requirement here, and what we're typically looking at is 90 days. So within 90 days of becoming resident. And of course, the question of residency is a question of fact. You could be in a province for longer than 90 days and not become a resident if your intent was not to stay in that province. For instance, you might not become resident at that 90-day mark, and that's where we have some requirements for different types of travel insurance, for example, for people who are visiting Canada. But if you're here to stay, you're becoming a resident, you take up work and employment, take up work here, bring your family here, do your banking here, and so forth, then within 90 days, you have to have access to this health care. Now, tying into that is the concept of portability. So portability says that I can take it with me. I'm actually covered anywhere in the world. And there's a lot of misconceptions around this as well. Now, that sounds real good that I'm covered everywhere in the world, but it's not as good as it sounds. If I'm a resident of Alberta, which I happen to be, and I'm traveling elsewhere, Alberta Healthcare, which administers the delivery of healthcare in this province, says, okay, Jason, we're going to cover you to the extent that we would have covered you had something gone wrong in Alberta. So we'll figure out what it would have cost to get that health care provided in your home province, and then we'll pay for that only to the extent that something went wrong while you're traveling. And then there are further limitations, and we'll deal with that when we talk about travel insurance. But a limitation that also can be in place is if I'm specifically told by my doctor not to travel, Alberta Healthcare is going to say, too bad, you made a decision that was going to cost us money and you knew it. We're also not going to cover you in that circumstance. Comprehensiveness, then. Now, this is the one that's probably the most contentious, and this is where we have a whole bunch of different items that vary from province to province. The idea with comprehensiveness is that we're going to have medically necessary services covered, but there are lots of exceptions here and some things that some people would probably suggest are medically necessary. So a lot of provinces, for example, don't cover ambulance rides. And other things that might not be covered here, most dental work is not covered, although in case of a medical emergency that requires dental surgery, that dental surgery should be covered. Most prescription drugs are not covered unless you get those drugs in the hospital while you're receiving treatment in hospital. For the most part, vision care is not covered. So there are fairly broad ranges of things that are not covered under the delivery of the provincial health care, in this country. Public administration. So what this means, it doesn't have to be publicly delivered. You can have privately delivered healthcare that's publicly administered. This means that the insurance and administrative processes have to be public. So there has to be some public body that ultimately oversees how this service gets paid for. Some sort of health board or something like that. But this doesn't restrict the use of private services, although there are some problems with that sometimes, and we had notably a conflict between British Columbia and the federal government some time ago about the use of private clinics to deliver health care. And then accessible, so this is where we can't have any sort of user fees. I can't charge you $10 to walk into a hospital, for example. This is where we do have some potential problems, again, with the private delivery of healthcare, but for publicly funded healthcare, there cannot be a user fee. Now, there are things that you pay for sometimes, like parking at the hospital. Prosthetics, for example, are another example of a comprehensive item that's not always covered. So if you need crutches or a wheelchair or something like that, then you'll find that you may have to pay for it, even though you might consider it medically necessary. There are a few examples of groups that are not covered under, or not going to have their healthcare provided under, the provincial system. So we do see, in some cases, the federal government involved in the delivery of healthcare, and some examples where you'll see this are with, let's say, RCMP and members of the Canadian Forces, regular force members of the Canadian Forces, and certain people covered by various treaties. So sometimes when we have somebody who falls under the Indian Act or various Aboriginal groups, then we may also see the federal government deliver health care. And then, of course, in the territories where there are no provincial governments. So that's a broad overview of the Canada Health Act. It's quite useful to understand this if you're dealing in a market where there's any sort of requirement for private medical insurance, and that's very common. It's a common group benefit. Travel insurance we'll see a need for then if you have visitors to Canada, if you have people who have higher healthcare needs than just the very basic stuff provided here. And as an example, the Organization for Economic Cooperation and Development tells us that in Canada, 70% of our healthcare costs are publicly funded. That means that each of us pays about 30%, or on average, 30% of our healthcare costs. So there is some demand still for private health insurance in this country. But of course, the Canada Health Act and its associated structures give us a pretty good blanket as far as medically necessary services. I hope this helps. I hope you enjoy your continued studies. Thank you very much.